Hey everybody, today I'm talking about investing during an election year. It's kind of like a Wimbledon final. The best players battle their way through the early rounds. Oh wait, that didn't really happen, did it? All right, scratch that comparison. Okay, just like Federer fans versus Rafa fans, or Djokovic fans versus the both. Politics can stir up strong feelings, but when it comes to investing, it's best to keep your eye on the ball and stay focused. So here are 3 common mistakes investors make during election years and how you can avoid them this year. All right, mistake number 1, worrying too much about which party wins. Yeah, it's natural to want your candidate to win, but making investment decisions based on election results can be risky. Historically, election outcomes have had little impact on long-term investment returns. Yeah, sure. You've got your favorite guy, and you think the world, or at least the United States, will come to an end if your guy or girl doesn't win. Oh yeah, by the way, this is the most important election of our lives. Where have I heard that before? The last election? And the one before that? Funny how each one becomes the most important election of our lives. What's more important is staying invested. For example, a $1,000 investment in the S&P 500 when FDR took office would be worth nearly $22 million today. And that period saw 8 Democratic and 7 Republican presidents. Apparently, the market doesn't care which party is in the White House. Avoiding the market due to election fears could have seriously hurt your long-term returns there. So, while elections have clear winners and losers, the real winners are investors who stay the course. Much like a tennis player who keeps their focus and plays their game no matter who their opponent is. All right, here's another mistake, number 2. Getting spooked by pre-election volatility. Yeah, we saw that this summer. Markets hate uncertainty, and nothing screams uncertainty like election season. But this volatility is often short-lived. Once the primaries are over and candidates are elected or chosen, maybe it is, markets usually settle back into the normal upward trend. Think of it like the opening rounds of a tennis tournament. There's a lot of excitement and unpredictability, including some major upsets sometimes. But as the tournament progresses, the top players start to emerge and things become more stable. Pre-election volatility can create buying opportunities. For example, policy proposals often target specific industries, putting pressure on their stock prices, like the healthcare sector, often facing scrutiny over drug pricing during elections, and that causes a temporary dip in their stock prices. And mistake number 3, trying to time the markets around politics and elections. Yeah, you're feeling nervous about the market this year because there's a presidential election. You're not alone. Candidates often highlight the country's problems, amplifying negative messages all over television and social media. And this leads investors to be more conservative with their portfolios ahead of elections. All right, since 1992, investors have tended to move money into cash, out of investments, parked it in cash before November elections, and then they move it back into stocks afterward. But market timing is rarely a winning strategy. To test this, I looked at research on investment returns over the last 23 election cycles. Capital Group, a major mutual fund provider, compared 3 hypothetical approaches: staying fully invested in stocks, making monthly contributions to investments, or staying in cash until after the election. I bet you can guess, the investor who stayed in cash had the worst outcome in 17 of 23 periods. And those who stayed fully invested or made regular contributions, well, of course, they did better in the long run. So, what's the best course of action for you? Well, stick with a sound long-term investment plan based on your goals. Whether you're fully invested throughout the year or consistently invest through a 401k at work, avoid timing the market around elections. Focus on your long-term goals, not the short-term noise. It's like playing a 5-set tennis match. You've got to keep your strategy steady and not get thrown off by a few breaks of serve. Here's how you avoid these mistakes. Don't let election predictions or the polls influence your investment decisions. History shows election results have minimal impact on long-term returns. And expect the volatility. It's a normal part of investing, especially leading up to the election. But don't fear it. View it as a potential buying opportunity. And stick to your long-term investment strategy. Investors who stayed invested or made those regular contributions have historically done better than those who stayed in cash during election years. And never forget, you're an investor. You're not a trader or a speculator. You don't do market timing or economic forecasting. So remember, keep a cool head and focus on your long-term goals. Just like in tennis, staying calm and sticking to your game plan is key to success. No unforced errors. And soon you'll hear game, set, match, election over. I'll see you in the next episode.